So let's start with chapter 6, which is mutual funds. So mutual fund investments are investments in line with the investment objective, backed by adequate research and supported by prudent investment processes. So that is the basic definition of mutual funds. When we look at why you should invest in mutual funds or what are the benefits of it, the first and foremost benefit is affordable portfolio diversification. Now, if you have to have a similar diversification like you have in a mutual fund scheme through direct equities, then you will need to invest in around 50 to 60 different scripts or different stocks, and that will require a lot of money. So possibly that is not advisable or possible for a lot of investors. Hence, mutual funds is a better option as compared to direct equities when it comes to having a decent portfolio diversification, and that too in an affordable manner. Economies of scale. So basically what happens is, since I get crores and crores of rupees as a fund manager in mutual fund scheme, I'm able to buy stocks at a much better position. So since I buy in bulk quantity and in huge values also, I'm able to achieve economies of scale through mutual funds as a fund manager and as an investor also. Transparency is there here. So what happens is, whatever stocks are being held under the mutual fund schemes, those are detailed out in the fact sheets which are there. Plus their weightage is also discussed. Any exit entry is also clearly mentioned there. All your charges are clearly mentioned. So there's 100% transparency in mutual funds, unlike some other products. Tax benefits, definitely yes. You have the ATC benefit, which is there in the ELSS or the equities linked savings schemes, which is there. So the limit of 1.5 lakhs for ATC, one of the instruments available is mutual fund ELSS schemes there. Also on the long-term capital gains point of view, as compared to a normal salaried class who would land up in the 30% bracket, the LTCG or the long-term capital gains in direct equities, mutual fund equities, that is roughly 10%. So that also is a definite benefit for the investors. Convenient options, so you can enter in various options into the mutual fund schemes. So one is your obviously lump sum, which is there. Then you can enter via SIPs, which is systematic investment plans. You can also do a STP, systematic transfer plan, from liquid or debt funds into equity funds. You can top up your SIPs, you can step up your SIPs, all those are options available. Plus, any point of time, if you feel that you need to stop an SIP or an investment in mutual funds, you can do that as well. So everything is very convenient for the investors. Regulatory comfort. So you have the SEBI, which is there, which is a very, very strong body who regulates equity markets. They also regulate the mutual fund markets. You have RBI in case of debts and so on and so forth. So the regulators are very strong. Anytime if anything is seen which is not in the benefit of the investors, they immediately come into picture and do the corrections which are required. So regulators are there to support the investors here. So these are few of the benefits of investing in MF schemes. The legal structure of MFs, if I have to understand, there are some important terms which you need to know. First and foremost, there's something known as sponsors. So it is a trust. So a mutual fund is a trust which is created by one or more than one sponsors. It is governed by the Indian Trust Act 1882, sorry. The beneficiaries are investors who invest in various schemes. So who is the beneficiary of a mutual fund scheme? The investors of the mutual fund schemes. So it is not the AMC, it is not the it is not the promoter of the mutual fund scheme or the board of directors. No, it is the investors who invest in the schemes of the mutual fund. Operations of the trust are governed by the trust deed, which is executed between the sponsor and the trustees. So there's a trust deed which exists between the sponsors and the trust deed and the trustees, and that is how the operation of the mutual fund happens. Trustees' basic job, as the name suggests, is protecting the interests of the investors. So that is what they do. That is what is their job. Day-to-day affairs of the schemes are managed by the AMC, Asset Management Company. So they manage the NAVs, etc., etc. So all that is done by the AMC. Let's continue the legal structure. So the AMC is appointed by the sponsor or the trustees. So it is the sponsors of the trustees who appoint the asset management company. The scheme's assets are held in custody of the custodian appointed by the trustees. So they are the people who control everything. They are the people who hold everything. In DMAT kind of a situation, that does not actually help. But in the earlier days, when you had physical forms and physical certificates were maintained, that time the custodian's job was very, very important. Even now it is there, but it is now in the DMAT format. The record of the investors, their unit holdings is maintained by the AMC itself, not by the custodian. It can appoint an RTA or a registrar and transfer agent. So that is possible. They can maintain that. They can appoint an RTA. The AMC can do that. The sponsor or the trustees shall appoint the AMC with the approval of the SEBI. So they cannot directly go ahead and appoint anybody under the sun. They have to give a proposal to SEBI, and then SEBI scrutinizes the proposal, post which it will either approve or disapprove. Compliance function, if I have to look at it, there are certain rules, laws, regulations, and compliance parameters which are important for us to understand. A compliance officer needs to ensure all legal compliance are in place. So that is the pure or the basic function of a compliance officer. That whatever are the legal parameters which are there, that the compliance officer ensures that the organization follows those parameters. As I was saying, compliance officer directly reports into the head of the AMC. If this was not the case, then other departments could have influenced the action of the compliance officer, which is not in the interest of the customer. So that is where the compliance officer directly reports into the head of AMC. Then the analysts analyze individual securities, sectors, state of the markets, economy, etc., etc. So there are analysts which are important in the organization. Then they also analyze the stock and the debt markets in details and examine the credit possibilities. So that is the job of the analyst which is there. Analysts also analyze the interest rate movements, identify investment opportunities. The opportunities are presented to them by the analysts, brokers, and other research firms, etc. Once this is done by the analyst, the entire research is done, this is presented to the fund managers. And it is up to the fund manager and the CIO, equity or debt, to take actions or not take actions basis this information provided. So analysis is just a team which supports in terms of all the analysis which is there. The final decision is taken by the fund manager in consensus with the CIO, equity and debt, as well as the head of the organization, the MD or the CEO. Performance of the scheme of the fund is the responsibility of the fund manager. So he or she needs to ensure that since investors are putting their hard-earned money, they get optimal returns as per the particular scheme in which they are investing. Dealers place orders on instructions of the fund managers. So that is what the dealer's job is. Now there is something known as RTA and fund accounting team. Let's have an understanding of that. So RTA is nothing but a short form for registered and transfer agents. So what is the role? Let's understand that. They maintain investor records as well as allot or redeem units. So when units need to be allotted or redeemed, that is what the RTA does. They process the purchases, redemptions, switches, dividends, etc., etc., and generate an account statement for the investors. What does a fund accounting team do? The fund accounting team maintains books of accounts for each individual mutual fund scheme. They also calculate the NAVs on a daily basis. Coming to types of mutual fund products, by structure, you have open-ended schemes. So what is an open-ended scheme? This is generally a scheme which remains open for transactions throughout, right? They have a fixed maturity date. Investors are allowed to enter or exit the scheme anytime after the NFO. So basically, it's open door kind of a thing. And there's a maturity date which is there. Till that time, anybody can enter or exit the schemes, as the name suggests. Then you have something which is close-ended schemes. These are open during NFO for a period of 15 days. And post that, they close. And then no further subscriptions are entertained into this fund. There is something which is also known as interval schemes. So when you look at interval schemes, these are technically both open-ended and close-ended. Typically, these are close-ended funds only, but they are open for certain windows during the close-ended period. So for example, a fund starts and has an NFO, 15 days NFO is there, then it becomes closed. Then once in 6 months, it opens for a period of maybe 15 days. And again, after that, it will close, continue to remain closed. Again, after 6 months, it will open for a period of 10 to 15 days. So that is that's a typical interval scheme. Okay. So that is by the structure. By the management, if you have to see, there are active funds and passive funds. So what is an active fund? Let's first understand what's a passive fund. So then we move to the active funds. A passive fund is earmarked to a particular index. It can be broad-based index, like you have the Nifty or the Sensex, or it can be micro-level indexes also. What is the job of a fund manager in a passive fund kind of a scenario? Initially, when the NFO is there, before the NFO is there, the fund manager will need to create a portfolio which is exactly mirroring the benchmark portfolio. Okay, so if that's an index, here in this case, so it will exactly mirror the index. What do you mean by mirror? It will have the same stock allocation as is there in the index. So if the index has 30 stocks, the same 30 stocks will feature in the scheme's portfolio also. If it has 50, it will reflect as 50 there also. Exactly similar. The second similarity is the weightage. So let's say there is a particular stock at 3.27% in the main index. It will also be 3.27% in this mirror index. So once this portfolio is done, nothing much needs to be done by the passive fund manager. Only when there are changes in the index in terms of either some stock enters or exits the index, or the weightage is changed because of certain situation, that is the time the passive fund manager will have to adjust the portfolio in tune with the changes in the basic index. So if it is going to mirror the basic index, the returns are going to be very, very similar to that of a basic index, specified index, understanding that there will be a tracking error. Why tracking error? Because the size of the index is huge. That will not be the size of the passive fund. So because of that, what happens is I will not be able to get the deals at the same price at the same time, etc. So there is a small tracking error which is there. Otherwise, the returns of a passive fund will also mirror the returns of the benchmark index or the specified index. So this is a passive fund. What is the active fund? In the active fund, the fund manager decides on the portfolio and creates a portfolio which he or she feels is going to outperform the market. He can also titrate the weightages basis his understanding of the future of the markets. Even there is something known as underweight and overweight in active funds. So if the fund manager feels that, okay, this sector is going to do well going forward, then he may overweight in that sector. If he feels counter, then he may underweight that sector. So that is also about his perceptions based on obviously calculations which are there, that what will happen in the future in terms of the stock markets, in terms of index, in terms of sectors, and in terms of individual stocks. Ideally, whenever a person invests in an active fund, he or she expects alpha to be created over and above the benchmark returns or over and above the index returns. But that may not happen throughout the time, because for certain situations, what can happen is it will outperform. But certain situations, because of overexposure to equity also, it can give you underperformance for a short period of time. One more important difference between active and passive funds is the developed or the developing nature of the markets. So if you go to developed markets like US, passive funds returns, the difference between, or the spread between passive fund returns and active fund returns is not much. So as it is said that there is lesser chances of alpha generation because the markets are matured. Whereas in developing markets like India, still a huge alpha is possible between active funds and passive funds. Hence, a lot of people prefer active funds. Okay, so that was the difference. By investment horizon, if I have investment universe, if I have to see, you have equity funds, fixed income funds, money market funds, gold funds, international funds, and so on and so forth. Then basis market capitalization, you have large cap funds, mid cap funds, small cap funds, flexi cap funds, multi cap funds, and so on and so forth. Basis, then you also have your government security funds, corporate debt funds, etc., etc. So that is the basis, the investment universe. Process of investing in mutual funds. So am I eligible? Yes. Residents can invest, NRIs can invest, PIOs or persons of Indian origin can invest, foreign nationals, institutions and trusts, all of these can invest in mutual funds. PAN card is mandatory. So without a PAN card, you cannot be an investor in the mutual funds. When the investment is made by an individual investor, either as a lump sum or SIP, do not exceed 50,000 per annum per mutual fund. Okay, so that is where it is excluded, but otherwise PAN card is mandatory. Process of investing in mutual funds, purchasing units of mutual funds. NFO typically stands for, you start with an NFO normally. A lot of people do that. So NFO stands for the new fund offer. It will be open for a period of 15 days. Units of closed-ended funds are mandatory listed on the stock exchange. Redemption refers to withdrawing. And you have systematic transactions, which are SIP, SWP, and STP. So you have the systematic investment plan, where I systematically invest into the mutual fund scheme. Systematic withdrawal plan, where I move money out of the mutual fund scheme in a systematic manner, something very similar to pension plans or monthly payout FD kind of products. Then you have systematic transfer plan, where I move from one set of funds to another set of funds. So I can move from liquid funds to equities, debt to equities, and so on and so forth. SEBI regulations, some of them. So mutual funds are primarily regulated by the SEBI. Investors' money is held independently and not on the AMC's balance sheet. Publishing the fact sheet on a monthly basis is not a regulatory requirement. So these are key three things which are there. Already you know that mutual funds is regulated by SEBI, so that was understood earlier also. Investors' money is not in the AMC's balance sheet. It is held independently. And finally, you have the monthly fact sheets, which are not a regulatory requirement. NAV, TR, etc. So in case of fund of funds, where the investing is done in liquid funds, index fund schemes, exchange traded funds, the TR or the total expense ratio of the scheme shall not exceed 1% of daily net assets of the scheme. If when you're investing in a minimum of 65% of assets in under management in equity oriented funds, it shall not exceed 2.25%. Investing in schemes other than that specified above, 2%. And in case of an index fund scheme or an ETF, it is 1% of daily net assets. Now, remember, there are, for the exam point of view, if you have to see, there are a lot of numbers which are given in the presentation or in the book which you have. So these numbers need to be remembered as is. because these percentages, etc., and there are other numbers also which may be asked in the exam. So my suggestion would be, whenever you're reading the material, keep a separate notebook with you, and wherever numbers are mentioned, just make a note of that at just under each other. So after one another, you can just make a note of those numbers, so that when you're revising the content, you can actually go through the numbers and try to memorize them in some logical format, so that anything on the numbers comes, you'll be able to answer it, right? So finally, the TER to be charged over and above the weighted average TER of the underlying scheme shall not exceed twice the weighted average of the TER levied by the underlying schemes. Clear? MTM here stands for mark to market. TER. So in case of close-ended and interval schemes, it shall not exceed 1.25% of the daily net assets of the scheme. The total expense ratio of close-ended schemes and interval schemes other than schemes specified above shall not exceed 1% of the daily net assets of the scheme. And these are the slabs. Now, if you're on, you can take a pic of this slab, because this left-hand side chart which is there is very, very important. There are multiple questions which come on this. So let's say I can ask a question that, so I am investing 750 crores is there as a daily net assets, and for the last 250 crores, what would be the TER in case of equity oriented schemes? Now, if you remember this, you know that the answer is 2%. Or if I change that question and say other than equity oriented schemes, you know that the answer is 1.75%. So this is direct question. So it can say, okay, this is a 2000 crores fund, daily net assets, and what happens after 750 for the last 1250 crores. Then I know for equity it is 1.75, for debt it is, for non-equity it is 1.5%. Complicated question can be, okay, I have a fund which is 2500 crores. Now tell me what will be the total expense ratio in numeric terms, in rupee value terms. So what I will do is I'll multiply 500 by 2.25%, note down that value, 250 by 2%, note down that value, 1250 by 1.7%, note down that value, and the last 500 is in the fourth slab, that I will multiply by 1.6% and note that value. Add up all these values, I'll get my answer. So such questions also come. So you need to remember this table. So make a note of it and ensure that you revise it before you go for the exams. Key performance measures. So let's have a look at that. So SEBI has established certain advertisement guidelines for mutual funds. When a mutual fund scheme is held for more than 3 years, the CAGR of 1 year, 3 years, and 5 years since inception should be provided along with the respective benchmarks. When a mutual fund scheme is held for more than 3 years, point-to-point returns on a standard investment of 10,000 rupees shall be also shown. What else is important? If the performance figure is available for at least 7 years, 15 days and 30 days simple annualized yields can also be used for advertisements. For measuring the risk, variance, standard deviation, beta, tracking errors are calculated. And finally, coming to the ratios, so the Sharpe ratio, the traders ratio, information ratio, alpha, tracking error, etc. in case of index funds can also be disclosed. Okay, so with this we end the 6th chapter.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.